When an economy contracts, two distinct groups emerge. The first group watches their savings evaporate. The second group quietly accumulates massive fortunes. We saw this exact split happen in recent history. In 2008, the housing crash ruined millions, but it also minted a new class of millionaires. In 2020, while global markets froze, certain portfolios expanded overnight. Markets tend to move in cycles of roughly 8 to 12 years. Given the time elapsed since the last major shocks, many analysts are now looking toward 2026 as the next significant realignment of capital. Landing on the right side of that realignment requires a specific strategy. By the end of this video, you'll understand why the peak of economic fear is where the largest financial opportunities are actually found. People assume economic downturns simply vaporize money, but that is mathematically incomplete. A recession acts like a filter. It clears out fragile operations and over-leveraged debt. It destroys weak money, but it transfers that exact capital into strong, resilient hands. When panic takes over the news cycle, the market stops pricing things logically. Investors dump everything. Stocks suddenly drop, real estate softens, and highly valuable assets are suddenly trading at steep discounts. This creates a predictable behavioral loop. The average person watches their portfolio drop and sells to stop the pain. Meanwhile, the experienced investor sits quietly, analyzes the drop, and prepares to buy its exact same assets. Billionaires treat these cycles as the primary driver of their growth. They spend the stable years building cash positions specifically to deploy when the market breaks. During a market dive, your biggest advantage isn't the size of your bank account, it's your emotional control. The average investor lets fear override their logic. They check their balances obsessively, read every scary headline, and ultimately sell their holdings at the exact bottom of the cycle. But the wealthy operate on a completely different timeline. They know that economic dips are temporary, but the ownership of a cash-flowing asset is permanent. It's exactly what Warren Buffett meant when he advised investors to be greedy when others are fearful. That single piece of logic has generated billions. Yet, even knowing this, almost everyone falls into one specific psychological trap during a downturn, and it's the exact reason they stay broke. That trap is waiting for certainty. People see mass layoffs and negative GDP reports, so they pull all their money out, waiting for things to feel safe again. This chart shows the critical timeline trap. Notice how financial markets rebound months before the economy feels better. The market prices in recovery, while news reports the crash. Holding cash until the economy feels normal means you miss the massive gains. So instead of waiting, smart money moves early. They spend the boom times building up cash reserves. When the panic hits, they start deploying that capital into high-quality companies that are suddenly on sale, completely ignoring meme stocks or online hype. Imagine two neighbors watching the same market crash. One stares at the red numbers, panics, and sells his retirement fund at a loss. The other looks at the same numbers, sees top-tier companies down 30%, and starts buying. 5 years later, their net worths are worlds apart, because strong businesses inevitably survive and capture the market share of the weak ones that failed. Buying them at a discount isn't a gamble. It is a calculated move based on the certainty of mispricing. This brings us to a reality most people don't want to accept. The foundation of true generational wealth is rarely built when the economy is booming. A wealth transfer is the mechanical movement of assets from highly emotional people who can't handle pressure, directly to highly patient people who can. The investors who win this game track these macroeconomic cycles closely. They know that societal fear is the only mechanism that reliably creates untouchable discounts. Capitalizing on the next downturn requires a specific operational framework, one that prioritizes logic over survival instincts. The glowing blue board reflects a classic economic pattern, a sharp, terrifying drop followed by a quick recovery spike. Your 2026 strategy must anticipate this movement. Build your cash position now. When the drop happens, stay completely calm and acquire quality assets while others exit. Reacting to fear is incredibly expensive. Patience is highly profitable. In the middle of a crash, it always feels like the financial world is ending. But history proves that after every single collapse, the economy resets and entirely new wealth is forged. The largest financial rewards are always found in the periods people fear the most. To understand the mechanics of wealth and the psychology of large-scale investing, subscribe to Streets. Understanding these cycles early is the most